last video I made was on the book 100 Baggers by Chris Mayer, and it was recommended that I should compare my stock portfolio to the principles of that book to see how they hold up. So this video will serve as a case study for comparison. I have 3 stocks in my portfolio right now, and we'll go over all of them. I own ABXX Technologies, Aduro Clean Technologies, and Base Carbon. As far as the takeaways from the book that we'll compare them to, we'll go over principles 2, 3, 4, 5, and 6, as the others are more so characteristics you should take on yourself when investing, not traits that these companies themselves should have. Jumping right into things, we can start off with my largest position and move downwards. So that means we're going to look at ABXX Technologies first. The stock is around 55% of my portfolio, with a market cap of around 190 million Canadian. So the company clearly satisfies the small company criteria, so we can mark that off right at the start. For those who haven't heard of ABXX before, the company is developing a commodity futures exchange in Singapore, and the primary contracts they're planning to launch with are LNG, carbon, and nickel. So going from the beginning now, on the growth front, ABXX clearly doesn't fit the bill of what's described in 100 Baggers because there's very little revenue currently. The revenue is coming in was from existing assets that came from the company's reverse merger with New Millennium Iron in 2020, and the ABXX spin-out company Base Carbon that just started generating revenues as well, which they have a 2.5% royalty on. So this is to say that the company's primary focus, the commodity futures exchange, is not generating any revenues right now. So theoretically, we're not off to a great start. Things get more interesting when we realize that ABXX is incredibly close to launching the exchange at this point. They're in the process of finalizing regulatory capital financing with strategic partners. Once that's done, the only milestones left are to receive official regulatory approvals from the Monetary Authority of Singapore. And the company will see significant growth once everything's ready, because they've already had 43 commercial partners express interest in using ABXX's products. So lack of contract volumes is unlikely to be an issue. Additionally, and we'll talk about this later on in the video, there's projected to be a significant TAM for these contracts in the future, and there's a good chance that ABXX will take a majority of that addressable market value. Moving on to the second trait of 100 Baggers that we're going to focus on, we have low multiple. Because ABXX has little revenues at this point, there's not really a sales multiple that we can focus on. But what we can look for in this situation is a margin of safety. Margin of safety essentially referring to a difference between the market cap and the intrinsic value of the company. So let's look at the value of the company that I was seeing in a video on ABXX I made around a year ago. At the time, I was conservatively giving the company's assets a value of around 285 million Canadian. This includes the exchange technology, the value of assets related to Base Carbon and other investments, the iron property from New Millennium Iron along with its port assets, shareholder equity, and the cash they had on hand at the time. And I say this was a conservative estimate of the valuation because the last comparable sale of an exchange's assets was the Singapore Mercantile Exchange in 2013, which sold for $150 million to ICE. If you adjust for inflation and convert that to Canadian dollars, that's around 270 million CAD on its own. So 285 million is clearly conservative with all the assets on ABXX's balance sheet. This is not even mentioning how ABXX's exchange technology is probably more advanced and not including any value for their ID++ and blockchain technology, which the CEO, Josh Crum, is incredibly bullish on. So even at a 285 million valuation, compared to ABXX's current market cap of around 190 million, that's around a 30% discount to intrinsic value right there, as ABXX has little debt, but they ultimately don't have many liabilities. So while it's not on a multiple based on sales, there is a clear discount to the company's existing assets. But moving on to the moat, what type of moat does ABXX have? Well, the first type they have is around intellectual property, because they have a variety of patents and more pending. The CEO even talked about how they got a patent on the process of patenting, where you can put an immutable record on the blockchain to confirm that you were the first person to come up with an idea. So that's one of them. But the most crucial is going to be network effects, which is not a moat that they currently have, but one that they can have later on as they establish benchmark futures contracts. which is a futures contract that has, at least around 50% of the market share, or is the basis that other contracts in the market are based off of. In the financial futures business, there are naturally winner-take-most markets, as you need adequate liquidity for proper pricing signals, so market participants actually benefit from these exchanges. Otherwise, they might as well not even use the exchanges and go back to brokering deals between themselves with no intermediary that's taking a cut on the trade. Because of this, there are going to be very few competitors once you have an established benchmark contract. So if Abaxx can create new benchmarks in the markets that they're targeting when they launch, particularly LNG and carbon, then that's a very difficult moat for other companies to deal with. Lastly, you could argue that Abaxx would have a moat around efficient scale as well, because it's incredibly complex to create a regulated futures exchange and clearinghouse. Abaxx has been working on developing their exchange for around 5 years now, and there are not many exchanges around the world, and Abaxx will have the only one dedicated to physically delivered commodity futures in Asia outside of China. So Singapore is definitely a strategic position to be in. As far as insider ownership is concerned, this screenshot's from an outdated presentation, but just to give you an idea, there's been minimal dilution in the company, so insiders still own, give or take, around 20%. Josh Crum, the CEO, owns around 15% himself, and angel investors likely still make up a significant percentage as well. So Abaxx's float is pretty tight, and incentives are certainly aligned. Next up is Aduro Clean Technologies. The stock is approximately 30% of my portfolio right now, and the company is at a $48 million market cap as of the making of this video. Aduro is developing a new plastic recycling technology called chemolysis that has a variety of advantages in comparison to existing recycling methods that have to rely on subsidies or other funding means for profitability. So the potential growth profile of this company is absolutely massive, with the ability to not just recycle plastic, but there are other use cases as well, like breaking down heavy oils into lighter oils, or converting vegetable or other renewable fuels into petroleum products. With that said, the company is currently knee-deep in the process of scaling up and proving their technology, particularly in a partnership with Shell Game Changer. There's some revenue coming in from customer trials, testing out the recycling technology, but it's not like the company's rapidly growing at this point. They still need to reach a commercial scale first. There are a few reasons why I think the technology has been de-risked substantially already, which is why this company is a large position in the portfolio, but I've already covered that in other videos, so we'll leave it there. But moving on, we have a low multiple. And like with Abaxx, Aduro doesn't have sales multiples that we can speak on really, but we can focus on margin of safety yet again. In an interview the CEO of Aduro had with Mariusz Skonieczny, the CEO mentioned how he thinks the technology is bare minimum worth $25 to $50 million. And that was mentioned before any of the validation that's occurred because of partnering with Shell or other companies. So the value could end up being even higher. But regardless, with the market cap currently around 50 million, that essentially covers the downside of the stock, or at least covers it more than most companies could. So that gives me additional confidence in the value proposition. Now for the moat Aduro has plays into this idea. Their primary moat is the intellectual property. They have 7 patents issued and 1 pending, with more in development. So those patents protect what is essentially a monopoly that they have on recycling 80% of the plastic waste produced every year, because all the other recycling processes can't handle most types of plastic, but Aduro can. As I mentioned, there's more testing to do to confirm that, but per their latest press release, everything is going well so far with their new pilot units. Insider ownership for Aduro is the highest of the stocks I own, at approximately 40%. The best part about this company, though, is how they set up milestones to align themselves with shareholders. They didn't immediately give themselves all their shares, they actually locked them behind particular milestones, so insiders had to progress the company to increase their stake in it. I've never seen another situation like this. 1/3 of their shares were granted to them when they went public, another third was granted when they received third-party validation of the technology from a professor at Western University, and the last third will be granted to them after their technology reaches a commercial scale. So that should happen next year when they finish building their R3 pilot plant, which will process multiple tons of plastic waste per day. The last of my three stocks is Base Carbon, which makes up around 15% of my portfolio. The company has a market cap of around 45 million, so yet again the stock is another microcap, and clearly I only own small companies. But Base Carbon is a specialty financier of carbon projects, meaning that they finance carbon projects with the capital they need to scale, and then Base Carbon gets most of the revenues from the carbon offsets generated by that project in return. Ironically, the smallest position in my portfolio is the one actually generating free cash flow, as Base just booked 6.4 million in revenues last quarter. That was the first payment from their offtake agreement with Citigroup, who've agreed to buy carbon offsets from Base Carbon's project in Vietnam. Well, I think Base will grow the slowest out of my three stocks when all their business models are up and running. Right now, Base is clearly in the best position financially. They're set to benefit from significant industry growth tailwinds that will take effect over the next decade and beyond, as the voluntary carbon markets are projected to grow at least 15 times by 2030. So growth prospects are bright, and revenues are ramping up, as the company's Vietnam project is now producing offsets, and their project in Rwanda is likely not far behind. For the low multiple criteria, Base is incredibly undervalued compared to other companies in this general financing area of the market. They're currently trading at a 72% discount to net asset value. You could already see the disparity in September 2022 in a report from BMO on Base Carbon. But the differential has only gotten worse over time, so we're definitely at a low starting point here. Moving on to Moat, this is where things are not as glamorous for Base in comparison to other stocks I own. As a company in what is essentially a commoditized business, or close to it, garnering any substantial moat is going to be difficult. I'm mainly interested in this company for its exposure to carbon offsets. With that said, there are some advantages that keep competition relatively low for a company like this. First off, there's only room for a limited number of what will be large players in carbon project financing, because there will be a limited number of quality projects to finance. There's a natural ceiling for this type of business model, and it's likely that some of the earlier players are the ones that will remain and dominate over time. As you can see with large relative comparables in the precious metal sector, like Franco-Nevada or Wheaton Precious Metals, for example, their competitors are simply never going to catch up to the type of scale those companies have reached. Stealing their business is also difficult when, in many cases, there are long-term royalty and offtake agreements in place. So it's not like a competitor can just come in and easily take these deals away. The potential moat here essentially boils down to a mix of efficient scale and sticky switching costs. As you can see with insider ownership though, they own around 12% of the company, and because Base was spun out of Abaxx Technologies, ABXX owns 15%, and institutional or other angel investors own 35% as well. So the float here is pretty tight and liquidity is very low. So while all these companies aren't exactly what pop out to you on a stock screener, I'm pretty confident in their long-term prospects. I would say that finding fundamentally strong, undervalued companies with capital-light business models that also provide a benefit to the environment is not the easiest thing to do. But I think these three companies fit the bill pretty well, and I'm certainly putting my money where my mouth is when I say that, as I keep my portfolio incredibly concentrated. But yeah, check out the previous video I made on the 100 Baggers book if you haven't seen it already. And there will also be links to deals from both Simply Wall Street and Seeking Alpha in the description and pinned comment if you're interested in those stock research websites. Seeking Alpha is offering a $50 discount for your first year on a premium subscription and a 7-day free trial if you click on my affiliate link. So check those out below the video. Thanks for watching.